Do you feel about the some concrete evidence of a tax plan emerging from the US as well as the Bank of England rate hike? What is the kind of impact that we could see for starters in the dollar index, the pound sterling?
Well, I think first off, you've got to look at the pound sterling and then even take into consideration, since the middle of September, you've seen that US dollar index up around about that 94 and a bit, 94.3, 94.4. It was sitting around that 91 level, and there was all the chance that you would have seen a further softening at 90. But it certainly bounced from those levels, and it seems to be gaining a little bit of momentum at the moment. So, it's been a strong trade over the last matter of, a month and a half for the US dollar bulls, and at the moment it seems to be a very nice trade to be a part of.
Peter, the other major cue that we're getting in from the US is Trump has picked the successor to Janet Yellen, and it seems like the street was correct in predicting Jerome Powell, who will take over. He's an ex-investment banker, believed to be fairly cautious on the interest rate stand, but of course pretty ambitious, if I can call it that, in terms of financial regulations. What does this mean for global equity markets? What does this mean to foreign inflows and all that easy money that is floating around the world?
Well, I think it's going to be interesting how it plays out over the first, 6 to 12 weeks. The markets will take a very close look at it. It's a bit of an unknown, and naturally, with a new president only less than a year in tenure, and of course a new Fed chief, then I think it's going to level of possibly a little bit more uncertainty, which in turn is traditionally volatility. And it's probably not a bad place to be as far as from a trader's perspective, because I'll see movement. Now, the next part, of course, is going to be what happens as far as the Fed and the raising of rates, and what impact we're going to see as far as global growth and inflation. So I think as all of that plays into the mix over the next matter of months, it just adds to probably more confusion to the markets, and that's traditionally those states of where you put large drivers in there or large unknowns that creates that sense of ambiguity, and the markets always take that as a time to be very wary.
Right. Peter, what's your view on crude oil? Do you think that Brent sustaining above $60 per barrel, WTI above $54 per barrel, could we see further upside from here? Is it a sense that futures traders are getting confident with a higher bottom in terms of crude? Going into the winter months, the value of storage also gets enhanced. So, the distillate demand will also be important to monitor.
Well, exactly right. We're only less than 4 weeks away from the meeting in Vienna. I'll be there on the 30th of November, and that OPEC meeting. So in turn, I think leading up to that period, I can't see there being any major sell-offs, and I feel as though that the market will probably consolidate around these sort of levels. It could trend a little bit higher. It's been a very, very strong move to the upside over the last 8 to 10 weeks for crude. And playing into that, the compliance and stretching those cuts further back from March 31, they'll probably be, sent out even a fraction further, maybe even to the end of 2018 to get, the balance right as far as that oversupply. So, again, it's just a wait-and-see approach, what action OPEC's prepared to take and where pricing is. And even with the US dollar strengthening, and you've seen crude prices up, if the US dollar comes back off these levels, I think that would force crude up even further. So it's going to be a very fascinating lead into Christmas, and let's see what happens with OPEC.
Peter, moving on from crude, another asset class that we don't talk about often, but has been, of course, on most people's mind is Bitcoin. The rally on Bitcoin is shocking. Now around $7,000 is what we're getting in terms of pricing. Do you track Bitcoin?
Well, Samina, I track it, but I tell you what, I wish I would have bought some. I think it would have been a fantastic trade. Though, I listen to the likes of the Jamie Dimons and the Lloyd Blankfeins and, some of those big investment bankers and so on. Are we in bubble territory? Is it another tulip run? Is it another, an unknown? And what happens when, the momentum stops and you see big, sell-offs? It's a hard one to put any, I suppose, clarity to, because I think it's hit everyone by surprise in the sense of the huge parabolic moves. And when you enter a market like that, that there seems to be more traders entering, pushing it higher, buying. I'm just, like anything, I suppose there will be a day of reckoning, but at the moment it seems to be one-way traffic, and a lot of people are making a lot of money out of it. Samina, as I said, I wish I would have bought some.
I guess if you don't understand it, it's an asset class best avoided for most retail investors, at least. Peter, what about commodities otherwise? Because this morning the trade is fairly mixed. Early this week, Chinese economic data meant that you would see commodities going up. So you've got, you've got steel, aluminium. All of them seem to be in a mixed sort of trading range. Do you think there's more upside still remaining for commodity prices, or would you actually wait to see, real demand uptake to go long on any of these metals?
Well, demand uptick, but I think overall you're going to see continued uptick and increasing demand picture from, the developed world and from, emerging economies and the likes of, the Chinas and the Indias and the big growth engines of Asia. That storyline isn't changing. Concrete consumption, energy consumption, from electricity to engines to steel, you name it, everything needs to be produced. And so the demand, I don't think, is waning considerably. Demographics also, with population base increasing dramatically over the next 20 years globally, and primarily in that Asia region, that's going to underpin. And I like that, the old Jim Rogers bull, commodity guru. I think you've got to agree with him. That super cycle, this one's going to be one of the longest ever. They're traditionally about 19 to 22 years, I think. This one will probably run out to at least 2030, 2035. I think we're only halfway through it in a lot of reasonings. So don't be passive when it comes to commodities. One's got to have them in their profile and certainly in their portfolio, and it's only going to increase in demand and consumption for many decades to come.
Peter, tell us a little more in detail about what you feel about, gold, because now we continue to remain under $1,300 an ounce. We've seen us go to 1362. So at that time, the expectation was that we broken out of 1300, we could scale higher. But then the cool off was, as sharp as the up move was after the Jackson Hole meeting. One is that, and secondly, what do you feel about copper? What do you feel about aluminium and zinc, especially on the aluminium side? Do you think that could play the role of what zinc has done in the last year in terms of a deficit sort of a situation?
Well, I think there's further upside for the aluminium market, but moving straight back across. And as you mentioned, as far as gold, a lot of things have happened in the last 8 weeks that have taken the pressure off gold. And let me explain. First off, the geopolitical tensions with North Korea seem to have abated, and they're no longer, front page news. I'm not seeing it in Australia or global news headlines to the severity we were. The situation in the Middle East seems to have settled down a little bit further. Also, you've seen quite a strong move to the upside as far as US dollar index. And with the new Fed president and the concerns as far as global growth, gold's come off a little bit. So, I think it's still at $1,250. It's not a bad price. It's not a bad place to be. And I think overall, over the years ahead, you'll probably see it, stay at this sort of $1,200 to $1,400 range. Inflation's low, and that's another reason as far as, the gold price. Moving back to aluminium, those base metals, supply and demand, the big pictures, what they're pulling out of the ground, the nickel, the price volatility over the last matter of, a decade has been dramatic. If you put them on a chart, nickel, I think it went from about $6,000 or $7,000 a metric ton to $52,000, back down to $9,000. So it's a little bit like crude oil. They're all volatile, and if you get them on the uptick or the upswing, traders can do extremely well, or, of course, when they short them. So you've just got to see which way the market's going, look at your technicals, your fundamentals, and look at, of course, seasonality and how all of those contribute to as far as markets moving. I think that really gives us a very good indication as far as, price, mix, and moving averages and so on.